Learning objective number 4, construct financial statements and analyze the relationship among them. There are 4 financial statements that are required by generally accepted accounting principles. The 4 financial statements are the income statement, statement of retained earnings, the balance sheet, and the statement of cash flows. Each one of these statements addresses different financial elements of the organization. They answer different questions related to the financials. For example, question number 1 is, how well did the company perform during the year? Well, the financial statement that addresses that specific question is the income statement. The income statement is made up of revenues, less expenses, and it provides the net income. Revenues minus expenses give you the corresponding net income. The next question that might be asked is, why did the company's retained earnings change during the year? And the answer to that question can be found on the statement of retained earnings. We looked at this previously. We have beginning retained earnings. We're going to add any net income or subtract any loss. We're going to subtract dividends, and that will give us the ending retained earnings. Remember, the retained earnings is earnings that's been, or income that's been earned since the company began doing business, since its inception, minus any dividends paid out to shareholders. It's the cumulative income that's been retained by the corporation. The third question is, what is the company's financial position at fiscal year end? That question can be answered by looking at the balance sheet. The balance sheet is going to show you the assets, liabilities, and stockholders' equity. Notice that the balance sheet is really going to present the accounting equation. And then the fourth question that may be asked is, how much cash did the company generate and spend during the year? That question can be answered through the review of the statement of cash flows. And the statement of cash flows are broken down into 3 categories: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Once we sum up the 3 of these, whether they're positive or negative, we sum them up. And the net of all 3 of those will tell us whether or not cash increased or decreased during a period of time. Now, the order of the financial statements is intentional. Back in the day when we had to prepare these financial statements manually, it had to be done in a certain order. With technology, it happens the same way, except it just happens a lot faster and it happens automatically. The first financial statement developed is the income statement. We know what that is. It's showing the operational income for a period of time. That's going to update the statement of retained earnings. The statement of retained earnings number or numbers are going to be used to finish off the balance sheet. And then the balance sheet information is going to be used to help you develop the statement of cash flows. This order is very relevant, particularly when you're going to prepare these financial statements manually. Less relevant when you're using technology, but reality is technology is doing exactly what we did manually. They're just doing it a lot faster, and they're doing it automatically. Let's look at each one of these financial statements a little more closely. Let's look closer at each one of these financial statements. The first one is the income statement. And as we mentioned before, it measures operating performance. It is revenues less expenses. You're going to come up with net income, but net income is really determined by taking your total revenues and gains and subtracting total expenses and losses. Here's an example, and I think we looked at this right at the very beginning, the very first slide. This is Walt Disney Company. They called it the Consolidated Statements of Income statement. And they're showing the bottom line, $9.391 billion. Statement of retained earnings, we've looked at this already, but we'll look at it again. It's the portion of net income reinvested in the business. It's retained in the business. Net income increases retained earnings, losses, and dividends. If you lose money and or you pay income out, that's reducing retained earnings. And then net income or net loss flows from the income statement to the statement of retained earnings. So the income statement is required first. That net income is required in order to update the statement of retained earnings. So here's a representation, beginning retained earnings. You're going to add net income or subtract a loss. You're going to subtract dividends declared, and that's going to give you ending retained earnings. We've seen this a couple of times already. Here's an example of Walt Disney Company Consolidated Statement of Retained Earnings. The reason why they keep referring to as consolidated statement is because Walt Disney Company owns a lot of different other companies. And so they take all these companies and they consolidate them into one financial statement. But when they do that, they have to refer to it. When they do that, they have to refer to the statement as the consolidated statements of retained earnings in this case, or the consolidated statement of income, or whatever it may be. And you could look at them very closely. Oh, these are different years. So, and their year end is, looks like October 1st, which is going to be a little confusing, but some companies actually have very different year ends, sometimes even in the middle of a month, which is interesting. So we ended up on October 1st, 2016, 66,000, actually these are in millions, 66,088 million. Now the company started off the fiscal year on October 3rd, 2015. This is what they started off with, 59,028 million. They had income for the year of 9,391. That number came from where? Let's go to the previous slide. Previous slides, 9,391 million. The income statement was developed first, and that helped for them to generate the statement of retained earnings. So this number comes from the income statement. We then have dividends declared. That's a subtraction. Other reductions, there's no detail here. We just have to go with what they're providing us. So that their ending retained earnings is 66 billion. We started off with 59, we ended up with 66. And we can even go back one more year. We ended the previous year, October 3rd, 2015, with 59,028 million retained earnings. We can go back, what did we start off with? We started off in that year, which is very interesting that their beginning of the fiscal year for that was September 27th, 2014. So they're at 53,734 million. Their net income for that year that ended October 3rd, 2015 was 8,382 million. We can go back to the financial or to the statement of income and see that that came from here, 8,382 million. And then we have dividends declared and other reductions so that you end up with retained earnings at the end of October 3rd, 2015 of 59,028 million. The next financial statement is the balance sheet. This is also referred to as a statement of financial position. This, in most cases, when I see this term, it's really a nonprofit organization, but it can be referred to as a, even in for-profits use this. But in most cases, people just refer to it as the balance sheet. The balance sheet reports three items: assets, liabilities, stockholders' equity. That's the accounting equation. and reflects the company's position at a specific moment in time. So you can think of the balance sheet as almost like a selfie. This is what we have at this particular period of time, like a snapshot. Here are the assets we have. This is what we owe in terms of liabilities, and the difference is really our equity. Now the balance sheet, more specifically looking at assets, are going to be broken down into more specific assets. We know what an asset is. An asset is a cost or a resource that has future value. But in the asset section of the balance sheet, we're going to break it down a little bit further. We're going to identify what we consider to be current assets. Current assets are assets expected to be used or converted to cash within one business cycle. If they're already cash, that is a current asset. So cash equivalents, receivables, money that's due if you have an accounts receivable, hopefully that's going to be converted to cash sooner rather than later. Most companies have like a 30-day policy. When they have a receivable, you pay in 30 days with the sale of their product or services. Inventories, what a company buys and then turns around to sell. Well, you hope that's going to turn over pretty quick, certainly within 1 year. So we're going to consider those to be current. And then we have what are referred to as prepaid expenses. Prepaid expenses are expenses that are paid in advance. And we'll talk a little bit more about this later, but even though they're going to be expenses, if we pay them in advance, at the time we pay them, they may not be an expense immediately. It may be in the future. So prepaid expenses is a way for us to hold. It's like a holding area until we're ready to recognize that expense. And in most cases, prepaid expenses are short-term. So those are going to be current assets. Current assets, when I refer or use the term short-term, current assets, those are all used interchangeably. Short-term assets, current assets, they mean the same. Expected to be used or converted to cash within one business cycle. Long-term assets, those are expected to benefit the company beyond just one year. Okay, so when we think about a long-term asset, we're thinking about property, we're thinking about plant, equipment, long-term investments, intangible assets, vehicles, things that you know that last a lot longer than 1 year. Here we have Walt Disney Company consolidated balance sheet. As of the fiscal year end, October 1st, 2016 and October 3rd, 2015. Let's just focus on 16. We have it broken down by current and longer term or other assets. These are the current assets, cash, receivables, inventories, other current assets. And then their longer term assets are film, television costs, investments, park, resorts, and other property, intangibles, and other long-term assets. At the bottom line, you will see $92,033 million of assets. Those assets are broken down between current and non-current assets. We use the term non-current in some cases to replace long-term. It's more common when you're referring to assets as either current or non-current. It's just more common to do that. You don't often hear someone refer to assets as long-term, although technically that is not incorrect. It is correct to refer them as long-term, but in most cases we refer to them as either current or non-current. Liabilities are different though. Current liabilities, those are debts due within 1 year, something that we have to pay. Well, we know liabilities, we've already talked about, are future obligations, something that you owe, debt. Current liabilities refers to debt that's due within 1 year. So the examples would be accounts payable. If you buy something on accounts payable terms and the company says, hey, you have to pay me in 30 days, that's a current liability. Salaries payable. Most people expect to be paid pretty quick. Some people pay monthly, but for the most part, Most people don't work 1 year and don't expect to get paid for a year or two. Therefore, salaries and wages are going to almost always be considered current or short-term. Short-term notes payable, meaning you signed a note to borrow a lump sum of money and you promised to pay it back. But when you signed the note, you promised to pay it back within 1 year. That's a short-term note. Accrued liabilities, we'll talk a little bit more about what that really means, but it's really just a liability, something that you owe. Just think of it right now as something that you owe. Long-term liabilities, that's debt that's payable after 1 year, something that you're going to be paying into the future for a long period of time. You can have what is referred to as notes payable. When you buy that car and you finance it for 4 years or 5 years, well, that would be considered long-term debt. Believe it or not, not all of it, but for now, let's just assume all of it. If you sign a note that's going to be paid off for 5 years, that is going to be considered long-term liabilities. When you purchase a home and promise to pay it back over 15 years or 30 years, that's a long-term liability. There's also long-term bonds payable, and we'll talk much more about bonds later, but bonds are just a borrowing mechanism that companies use. And in many cases, they're long-term. They're going to pay that back a few years away. So we often use the word short-term liabilities, but current liabilities is more commonly used. Current is what we use the formal way of presenting it on financial statements. However, this is what's interesting. Long-term liabilities is how it's referred to on the financial statements. We don't use non-current liabilities, even though technically non-current would be correct, but we don't normally use that reference. We use long-term liabilities to identify debts payable after 1 year. Here's the balance sheet, specifically the liabilities for Disney. Their total current liabilities appear to be $16,842,000,000. I believe this is 2016, October 2016. And then you can see their long-term borrowings as well. The balance sheet, so far we've looked at assets, we've looked at liabilities, and now we're going to look at equity. We talked about this. Equity represents the stockholders' ownership of the business assets. The examples of the equity accounts will be common stock, additional paid-in capital, retained earnings. We've talked about retained earnings already. Treasury stock is new, but that would also be a part of equity. Accumulated other comprehensive income loss. These two we don't need to worry too much about because we're going to talk a little bit more later on in the class. Common stock is going to be, we're going to use that. Additional paid-in capital a little bit, but for the most part, that will be something we cover much more when we reach that section of the course. And retained earnings, that's also something we're going to be using frequently. So remember common stock and retained earnings. Remember common stock and retained earnings now because that's going to be something we're going to be using frequently over the next few weeks. Here's the equity section of the balance sheet for the Disney financial statements. And you see the breakdown in those numbers. This here gives you a complete balance sheet that shows all of the assets, all of the liabilities, and all the equity. And here's what you want to remember, just like the accounting equation suggests, total assets, $92,033,000,000, total assets equal liabilities, $44,710,000,000, plus stockholders' equity, $47,323,000,000. So when you add these, when you add $44,710,000 and you add that to $47,323,000,000, when you add those two together, you're going to get 92,033,000,000. That is equal to total assets. So these two numbers have to be equal. The last of the four financial statements include the statement of cash flows. Statement of cash flows reports the cash receipts and cash payments. We talked about that. And we talked about the three areas: operating activities, investing activities, and financing activities. Now let's get a little bit more definitional on these. Operating activities includes cash flows from selling goods and services to customers. So this is about as close as you're going to get to the income statement. What you're going to learn later is that the income statement is not cash. That's a little bit confusing to us initially, but the income statement is not cash. The operating activities cash flows is cash. So I want you to think about the operating activities as if you're really thinking about the income statement, revenues and expenses, but specifically it's cash flows. It's not just revenue and expenses, it's cash flows from revenues and cash flows from expenses. Investing activities are cash flows from purchasing and selling long-term assets. At this point in time, it's probably more important that you just memorize some of this, and especially for your quiz, and maybe even the exam that the first exam. But over time, at some point in time when we start going into these financial statements in more detail, that's when all of this can kind of make a little bit more sense. So investing, purchasing, and selling long-term assets. The last area is financing activities. And again, just memorize this. Cash flows from borrowing or repaying funds or equity transactions. The next slide shows what you would expect to see when we're looking at a statement of cash flows. And you see that it's broken down between operating activities, investing activities, and financing activities. How these financial statements relate to one another, we can see the flow by first starting off with the income statement. I think I kind of showed you that a little bit already, but this helps to see this a little more closely. The income statement flows, it starts with the income statement. We take that net income, and that's actually going to flow to the next financial statements, which is the restatement of retained earnings. Here's that income, 9321. And this is added to the beginning retained earnings, and then you're going to subtract other things. But with the statement of retained earnings, we end up with a report that shows how much the ending retained earnings is as of a specific time, 66 billion. That number then flows through, that's presented on the balance sheet. And the balance sheet section, the equity section of the balance sheet, which now we know that retained earnings is under the equity section, shows the 66 billion, 88 million. So the net income starts here, flows here, is included in here. That dollar amount flows through to here. And now we can kind of see how these financial statements are all interrelated because they're all part of the accounting equation. There's no way around it. It's all of it. All of it is a part of the accounting equation. Now, looking at the balance sheet, there's going to be some information that we have from the balance sheet that carries over as well. As an example, our ending cash and cash equivalents balance, as reported on the balance sheet, is 4,610,000,000. That number should in fact match what's reported on the statement of cash flows. At the end of the statement of cash flows, it shows what the cash and cash equivalents amount is at the end of the year, 4,610,000,000. Another way of demonstrating that even the statement of cash flows is interrelated with all the other financial statements. Okay, our last objective here is to evaluate business decisions ethically. There are three factors that influence business and accounting decisions. Those three factors are economic, specifically decisions made that would maximize the economic benefits of the business. There are legal decisions, and free societies are governed by laws written to provide clarity and prevent abuse of others' rights. So we want to make sure that the company is compliant with the legal requirements set certainly by the United States government, but if we have any local laws, which would include state, county, city laws, we want to make sure that our business is in compliance with those laws. If we sell goods or services internationally, then we may have to learn what the international laws are or other country laws are specifically relating to our business. We've addressed economic, we've addressed legal. The last area here is the ethical. The ethical decisions that we have to address in business. And ethics recognizes that even when economically profitable and legal, some actions still may not be right. An example would be that there are people who argue that certain corporations and certain companies take advantage of child labor. So these corporations are doing what they believe to be the correct thing in terms of economics. They're doing what's legal because in some countries it's okay to hire children for labor. In fact, in some Southeast Asia countries, it's encouraged because they have so little economic activity going on in those countries. And so even hiring their children makes it so that at least there's some inflow of money going into that country, and that makes for a better economic environment for those specific countries. So a company could be doing everything that's economically right, everything that's legally right, but where it may come into a little bit of trouble is, well, is it ethical that a corporation here within the United States use child labor in other countries where it would be illegal here, but it's legal in other countries? Is it unethical for that company to take advantage of child labor that is legal in other countries? So that becomes an ethical dilemma. And now companies are often faced with having to deal with these ethical issues and to make the best decisions that they possibly can, taking into consideration the impact of their decisions from an economic perspective, a legal perspective, and also an ethical perspective. Now, accountants, beyond that kind of a company decision that has to be made, accountants have what we refer to as the AICPA Code of Professional Conduct. Now, this is about how we as accountants act within our organizations. And so the AICPA stands for the American Institute of Certified Public Accountants, AICPA, provides the industry a code of professional conduct with these principles. When we say the industry, we're talking about the accounting industry. And so in that regard, we're looking at identifying what our professional responsibilities are. We're taking into consideration the public interest. We are making sure that we put a high value on integrity, objectivity and independence, due care, and the scope and nature of our services. As accountants, we are responsible to ensure that we make good ethical decisions. It becomes our responsibility to act in a manner that is in the best interest of all interested parties. We do have to focus on the public interest. In other words, the whole point of these standards is about protecting the general public, protecting investors, protecting creditors, and to ensure that we are presenting accurate information for those who are making decisions. It is also important that, particularly if we work for a CPA firm, and the CPA firm is then going to conduct what is referred to as an audit. When they approach this audit, this is a financial audit. This is not a tax audit. It has nothing to do with taxes. It's all about making sure that what is being presented on a financial statement to interested users is reasonably accurate. So in that audit process, we try and do our best to keep what is referred to as our objectivity and independence. So I'll give you the perfect example here. I do CFO services for a number of nonprofit organizations in this area. Now the CFO, the financial Chief Financial Officer services, means that when they have issues, well, a large organization will just hire a CFO, but that can be relatively expensive. So in some cases, companies can't afford a full-time CFO, so they contract it out. But when it relates specifically to my ability to be independent, it gets a little bit tricky here because of my day-to-day activity with them and helping them with issues on the budget. I help them with the preparation of their tax returns. I help them with risk management issues, including workers' comp, any kind of insurance issues that they have, I help them with that. I even help them with payroll and the bookkeeping services that we provide. So it would be difficult for me to argue, because I'm so involved with this organization in a lot of different areas. It would be difficult for me to argue that I'm objective, that I have total independence. So in other words, if this nonprofit organization requires an audit, well, by nature of an audit, somebody coming in from the outside looking at it, the auditor, the one who comes in to actually conduct the audit, has to be independent. And so even though I'm a CPA and technically I can conduct audits, because I am not independent, then it would be inconsistent with the professional standards that I actually conduct the audit. In other words, according to the AICPA, I am not able to do this. So therefore, I can't be objective and independent when I'm so involved with their organization. Therefore, if in fact they have a need to hire an accountant to conduct an audit for them, we're going to have to find another CPA. Due care in our practice, we need to make sure that accountants are educated, understand the specific industry, and that we work in the best interests of our clients. That would be considered due care. And then scope and nature of services, whenever we do have a relationship with clients, we have to make sure that the customer really understands what is it that we're doing, that it's clear what we're doing. Going back to the nonprofit organization that I work for, I have to write out an engagement letter that clearly specifies that I am not independent. So the whole point of the AICPA is to make sure that accountants conduct their practice in an ethical manner. Okay. And these items here are really catered towards the CPA firms who conduct services for companies, organizations. And so those are our responsibilities as it relates specifically to how we conduct ourselves in relation to the services that we provide. Okay, I think that covers chapter 1. I hope you are able to gain some insight in this. And the next video should be chapter 2.